All right, hey everyone, we're going to go over some notes on home ownership today. And at the end of the video, I'll show you how to do the worksheet that you need to do on home buying. Okay, so you can go through all the numbers to see how you'd figure what a home mortgage payment would be for a couple different houses in different price ranges. All right, so we'll go through the notes first. Follow along, take some notes on your own, and this is the stuff we'll have to know. All right, so it says in order to have a healthy financial decision making, what percentage of your monthly income should typically be spent on your mortgage or rent? So we said that number was 30%. Okay. Now, here's the thing. I told you guys when we went over our budgeting notes that most Americans probably spend over the 30% healthy number for mortgage or rent, because if you look at the following, if you're a family whose monthly income is $10,000 a year, which is obviously a large sum of money, okay, that gives you $3,000 to spend monthly on a house or rent. All right, that's gonna be a nice place to live. It's gonna be a nice house. It's gonna be a nice apartment if you're renting for $3,000 a month. Okay. Now, if you look at 2 and 3, we're looking at lower income and middle income families. Now we're going to see when you do 30% of those incomes, you're not looking at a whole lot of money. Okay. So if we're looking at 30% of a $2,500 monthly income, that's going to be $750 a month towards a mortgage or rent. All right. Not finding many houses for $750 a month to buy, and even renting at $750 a month is going to be pretty low. Okay. So that's why I was saying that most Americans are going to be over that 30% threshold, because in order to even find something, you have to spend more than 30% of your income. And then again, looking at the middle, kind of middle earners at $5,000 a month, now you're looking at $1,500 a month is 30% of that. Yeah, now you're going to be able to find a place to rent or even a mortgage payment for $1,500 a month, and it's going to be a decent place. But when we look at that lower to middle income brackets, typically we're going to see most Americans over that 30%. All right, so the term foreclosure, all right, when we talk about credit, we talked about the term default. All right, when you default on a loan, it means you no longer are making your payments, you broke the agreement. That's ultimately what foreclosure comes after you have defaulted on the loan. Okay, so when you've defaulted on your home loan, a mortgage payment, you stop making your mortgage payments. That is when the bank has the legal right to foreclose on the loan, which means they can legally take back ownership of the house if you go so long without making those mortgage payments. Okay, now this doesn't happen overnight. I always like to explain this isn't like you miss one monthly payment, they're going to come and take your house or kick you out of your house. This takes a long time of multiple missed payments in a row. It's going to take time. A lot of banks are going to try to work with you first, because the cost for them to go through the foreclosure process is going to be very expensive. And then they have a house that they own that they have to take care of or fix up until they can sell it again. So most banks are going to be more willing to try to help you if it's in those first few months of missing payments, or to help you get back on track. Now, obviously over time, you can only go so long. All right, so what most banks are going to require when you go to buy a new house, if you want to get a loan for a house, whether it's new, brand new construction or a used house, all right, they're going to require some form of a down payment. Okay, so how does your down payment help the homeowner? It's going to do a couple of things. Usually, the more you put down, the lower the interest rate you're going to get, and the lower the monthly payments you're going to have. So it's going to help you out big time as far as making your monthly payments more affordable, and as well giving you a lower interest rate, so you're paying less in interest over the course of the loan. All right, so most people, trying to save large sums of money for down payments on houses is not an easy thing to do. So again, most Americans aren't going to have that money put aside for a down payment. So what they're going to have to do is pay this thing called PMI. It's called private mortgage insurance. All right, so PMI is just simply, you are going to pay an extra amount every month, right? And you're going to basically buy insurance for the bank in the case that you decide to foreclose on your mortgage. All right, so when you have car insurance is for you. All right, you're paying the car insurance for you to benefit you. If you cause a car accident, you can cash in on your car insurance. PMI is insurance that you're paying for, but you're paying for it for the bank. That way, if you foreclose on your loan, the bank can now cash in the insurance policy to make up for any lost monthly payments that you hadn't made, or for any costs that they're going to accrue as they put you through the foreclosure process. Okay, so It's an insurance policy that you're paying for, but it's for someone else. It's for the bank. Okay. So what they're going to do is they're going to add this PMI to your monthly mortgage payment, and banks are going to require you to pay a PMI if you cannot put 20% down. All right. So when I say 20% down, that means whatever the price of the house is, you have to put 20% down. Otherwise, you have to pay a PMI. All right. So here's another little table here to show you that most Americans don't have 20% saved to put down on a mortgage payment. So if it's someone that's buying a $300,000 house, you're talking about having to have 60 grand in cash to put as a down payment for that house to avoid the PMI payment. Okay. So again, most Americans aren't going to have 60 grand in cash laying around when they buy a $300,000 house. So they're going to take the loan, but then agree to pay that extra monthly payment for PMI. Okay. Even if you go to a lower end price house at like 110,000, that's still $22,000 in cash you have to have on hand as a down payment. All right. To avoid PMI. So, most Americans aren't going to have the $20,000 in cash to put down as a down payment. Now, look, if you're going for the big house, the $500,000 house, to avoid PMI, you'd have to have 100 grand in cash as a down payment to avoid the PMI. So most people, when they get the mortgage payments or take on those loans, they're going to be paying a PMI to get approved. You have to do this if you want to get approved for the mortgage. It's either pay the PMI, agree to pay the PMI, or have that large sum of cash as a down payment. All right, so typically there's two types of mortgages, okay? You got what we call a conventional mortgage and a adjustable rate mortgage. Slide this out of the way so you can see better. All right, so our conventional mortgage is just going to be just like the word says, a conventional. So you're going to take out a loan for 30 straight years, and it's going to be the same payment every month for 30 years for the life of the loan. All right, so if your mortgage payment is $500, let's say $1,500 a month on month one, year one, your mortgage payment is going to be $1,500 a month on month 12 of year 30. Okay. The only thing that might go up obviously go up over time is the property taxes. So you could see increases in your mortgage payment due to property taxes, but when we're talking about the loan itself, the loan payment is the same for the life of the loan. Okay. An adjustable rate mortgage is called an ARM, adjustable rate mortgage. This is where your interest rate could fluctuate. It could go up, it could go down. Sometimes you might do one of these early on when you're just getting a mortgage, your income's a little lower, so the bank will approve you for a lower interest rate. And over the first few years in your mortgage, the interest rate slowly goes higher. So you're kind of getting to pay lower interest now, you'll pay higher interest later. All right, so that way your payments are more affordable in those first few years of your loan, so you can afford it better. Okay. Then other types of adjustable rate mortgage loans will deal with the actual market. So the interest rates could go up, they could go down over the life of the loan. So that one's a little bit more tricky. The mortgage loans that are adjustable rates, those are a little trickier. You probably want to avoid those if you can. Conventional mortgage, you know what you got. So there's a term called escrow that we got to go over. There's kind of two parts to it. I tried to break it down as simple as I can because this gets a little confusing. But when you're buying the house, you're going to have this thing called an escrow account, all right, which is a third party. Usually going to be a lawyer or title company. All right, so this is going to be like the middleman. You got the person buying the house, you got the person selling the house. You don't want them exchanging the cash for the actual purchase of the home, okay? Or the documents of the purchase of the home. So the escrow is going to be that person in the middle that's going to be handling the documents and all the paperwork and the cash and the money going back and forth between the buyer and the seller and their banks, okay, to make sure that everything's legal and that when the sale is done, this person no longer owns the house and this person legally does own the house now. All right, and that's kind of the idea of the third party escrow. So it's an escrow account that all that stuff, all that information and documents are going into. The second type of escrow is called just your basic mortgage account, all right? So and this is typically how most people pay their mortgage month to month, is they're paying for multiple things out of one account, all right? So you're paying for your mortgage, your PMI, property taxes, your homeowner's insurance, all that stuff will be coming out of one account rather than paying your mortgage payment and then in 6 months pay your tax bill, property tax bill, and then in another 6 months have to pay your property tax bill again. And then when your insurance bill comes due, you can pay that in full. You're kind of just dividing your taxes, your insurance, your property, your mortgage payment, your PMI over 12 months. So you're going to have a month-to-month bill that's going to be more manageable. Okay, that way if all of a sudden your property taxes go up, you don't owe this large lump sum at the end of the year. You've been paying it monthly, so you've paid most of it off. You just might have to pay a little more going into the following year if your property taxes go up. Okay. A lot of information, probably making you really excited to grow up and own a house someday. All right, so home equity. This is what you want. You want to try to get a house that's going to go up in value over time, because that means as what you owe on the house is going down, the value of your house is going up. Now that means you have equity in your house. It's that difference between what you owe going down and what your value of your house is going up. Okay. And there's three things that are going to cause equity in your home to fluctuate. Okay. Big one is the market conditions. Like right now, in the middle of the Corona crisis going on, you probably got a lot of people, not necessarily able to go afford new houses. So values of homes might be dropping over the next couple of weeks, couple months, hopefully no longer than that. Okay. A couple of months ago, you go back a year or two ago, you saw a lot of neighborhoods around the Joliet West area that were kind of, vacant for a while. You had some new homes going. Then all of a sudden you had an increase in construction, new home construction, a lot of those neighborhoods. Market conditions are good. When you see that going on, the values of homes are usually going up. When you see less construction going on, usually values of homes are kind of coming down a little bit, okay? But over time, they're kind of going up and down. But in the long run, you want the value of a house to be, going up over time, okay? But there might be some ups and downs along that road. But market conditions are going to increase or decrease your equity. The condition of the property itself. So obviously, if you upgrade your home, you take care of it, new roof, you update like kitchens and bathrooms, finished basements, the property outside looks nice, it's well taken care of. That's obviously going to make the value of your house go up as well. And as the value of the house goes up, so does your equity. And then the schools in the area is another big thing that's going to increase or decrease the equity of a home. All right, if a school district is very good, usually home values are going to be a little higher. If a school district in the area is questionable, all right, sometimes home values are going to be a little lower. All right, the one thing that does not is your income. All right, sometimes people think, oh, my income went up, I'm going to have more value in my house. Well, if you're using that income to pay off your debt, then yes, all right, your equity would go up. But just because your income goes up doesn't mean your equity is going up. All right, so the last thing here is, what do many people blame the credit crisis of 2008 on? The credit crisis was this thing called predatory lending in the housing market. So we talked about this term with credit. Predatory lending is when bankers were giving loans to people they knew could not afford them, okay? And I'll post a video called The Crisis of Credit. It's kind of confusing, but as you go through it, there's some main points that I want you to pull from it. And the main point is this idea of predatory lending, that bankers were giving loans to people they knew couldn't afford it because they didn't care. If I was the banker, I'd give you a loan, but then as soon as you got approved and I got you in your house, I would take your loan and sell it to another banker. So you were making your monthly payments to that guy, not me no more. So even if I knew in 2 years you wouldn't be able to afford that mortgage payment, I didn't care because I made the commission off you getting the loan. And then I sold the loan to someone else, so your payments were going to him. So when you defaulted on your mortgage payment, it was the other guy that had to worry about that, not me. All right, and that's predatory lending. It's when bankers were taking advantage of that situation. Okay, and again, I'll post the video so you can watch, go through it, and just get an idea of how this screwed up the entire market, because you went from having just a few houses hitting the market because of foreclosure to hundreds of thousands of houses hitting the market because of foreclosure. So when there's too much of something, the value plummets, and that's what ultimately happened to the value of homes during that time period. Okay. All right, so I'm going to show you guys the worksheet that I want you guys to work on that goes with home ownership. Okay, so this is what it's going to look like. You're going to go through this too, kind of like the car buying activity we did. You're going to go through looking at buying two houses. The first house you're going to have to look for is going to be $200,000 or less. And then the second house you have to buy has to be $450,000 or more. All right, so it's kind of the same thing. You're looking for a house that's going to be, more likely a type of house that you're going to be able to afford when you're out of college, first years of your career, not making a lot of money yet. So this is going to be more of a reasonable price home. And then the second house would be maybe, go find a dream home somewhere with a lot of land or a big house or movie theater in it, whatever you want. That's over that $450,000 range. Okay. So once you have a house that hits that number, you would take the retail price and go ahead and start here and then go through the step by step. I try to make this flow so it should make sense as you go through it. But if you go step by step and then you add your interest for the mortgage loan, your property taxes on the home, got the homeowner's insurance, and then that PMI we talked about in the notes. Once you add all those together, you'll have your monthly mortgage payment. You'll see what it would cost you per month to live in that house. Okay. So I would use a couple different link options you could have, maybe a realtor.com. Zillow is another website you might be able to use. There's a couple options as far as what you might use for it. So I'll bring up an example here of realtor.com. And when you go to the site, you can fix the settings so you can make it so you're looking at just houses for that. So let's say we go Joliet, Illinois is where you want to look for a home. You can do it anywhere. If you want to live in a different city and state, feel free to do that. All right, so price here, go right to this right away. And the first house you got to look for has to be a max of $200,000. Okay, so max at $200,000. And these are the houses you're looking at. All right, these are all the houses in the Joliet area that are under 200 grand. Click on them, look at the insides, look at, find a house that you would actually like to live in. All right, don't just click the first one. And then once you find one, let's say you really like, this house here, $174,900. That's your retail price, $174,900. Go ahead and put that in the box and start your math problems, okay? To see what your monthly mortgage payment would be. And then again, once you're done, go to choosing a house that's over $450,000, not less than $450,000. I want you to find that dream home, okay? And even if you want to look in some fancy location, you want to go to an island or something. I don't care where you look for a house. It doesn't matter to me. Okay, so let's go back to Joliet, Illinois. And this time for your price, now do a minimum of $450,000. There we go. Okay, so now you're seeing the difference in the style of house you might be able to get, or a piece of land you could get, but I want you looking for houses, not land, so actually pick a house. There you go, how do you like that? $1.5 million, let's say that's the house you pick. Go back to the home buying activity, and then in your retail price for the 450 grand or more, put in $1,500,000 and start doing the math to figure out what your monthly mortgage payment would be. Okay, so that's it. I'll post all this stuff on Google Classroom. Make sure you watch the video before and finish this video so you know what you're supposed to do, and take some notes while you're at it.